notification me. Webinar will be. Sam, should we give them a few minutes to drop on? Or do you wanna go for it?
Yeah, we'll glad you guys have joined. We'll just wait for a few more people to join. A couple of
Okay, awesome.
Okay, good morning everyone, and welcome to this quarter's Cape Berkshire webinar. Obviously, it's been quite a volatile month, so look forward to going over this in more detail. As is normal, put any questions that you might have down into the chat box, which should be on the screen somewhere. And obviously, I'll come around to those towards the end of the presentation. Mark can't join us today, so you're left with just me. So covering off the introductory admin bits. So this presentation is just for information purposes only, doesn't constitute any financial, legal, accounting advice. It's our views as to what's going on in the world and to update you on portfolios. Cape Berkshire Asset Management is a trading name of Asset Wealth Management, which is registered with the FCA at 551744. These investments aren't suitable for everyone. Obviously, go through a financial advisor, which the vast majority of you would have done beforehand, but these are fairly mainstream investments. But obviously, it's important to make sure that people are aware of their investments before they do so. There is annual management charges applied to this. We can cover that in more detail if you wish to do so, but they're pretty transparent across all portfolios. Tax legislation may change in the future, so it might change some of the aspects of why we hold certain things, but that's not a huge mass concern within the NPS. And as is always the case, if investments may fall or rise more than other elements. So just looking at what we're going to cover today. So obviously the Q1 portfolio performance, which I imagine an awful lot of people are interested to hear, as well as what we did over the first quarter. And then we're going to have to go over the elephant in the room, the Iran conflict. Obviously, I've just gone over the last few days. Is it all over? Then obviously open the floor for questions and answers. So looking at the first quarter, it's a shame we ended up down on the quarter, which wasn't where we necessarily wanted to be. Obviously, going into February, we were up quite considerably, so it was quite a quick pullback within March. However, looking at the quarter in general, we see the P portfolios are largely up there against benchmarks. The ARC MPS benchmark was actually the harder set of benchmarks to outperform this quarter, which isn't normally the case. We normally find that we outperform those quite readily. So we'll see when we look in a minute in future slides, looking at the 1 year and the longer periods about performance versus those. But on the quarter, anywhere between down 0.5% and down to just over 2% for the quarter there. Looking at those there. But the problem is that at the moment is everything's, as you probably would have noticed, quite volatile, moving around quite a lot during the day. And a lot of obviously our performance versus benchmarks is determined by when our funds price versus theirs. And what's been going on quite a lot at the moment is that our funds will be pricing that at some point in the day, which might be very different to where the prices are in the market at a certain other point. So the internal benchmark, if you look a couple of days, well, a week forward to yesterday's date, so this was as of yesterday. So covering the year, we go from say for P5, for example, down 1.57%. 1 week later, we're up 3.5%. So we're up just over 5% in about a week, which is obviously fantastic. But also quite important there is when you look at the versus the benchmark numbers there, we've recovered around about 75 bips, so that's 0.75%, quicker than our peers. So very positive there. We've recovered out from this quite strongly indeed, and I think that's due to how we've dealt through the conflict in general. But I'm not necessarily saying this is the end of it. And then, yeah, as I was saying, the 1 year performance table there. So on the 1 year, looking at up to 10% returns, R1 is 4.99 up to the end of the quarter. So not including the extra of circa 5% over the last week or so. But as I said, just illustrating versus the ARC MPS, we've outperformed them quite a bit over the last year. Outperformed, apart from R2, that's got that one bit versus AFI. Outperformed pretty much all benchmarks over the year, and that's reaffirmed when looking at since the P&R portfolio started a couple of years ago up to the end of the quarter. See very good there, and as I said, this has improved somewhat over the last week again. So positive picture to paint there. And one thing that we've done very well over the last few years is that we've helped protect in downturns, but recovered quickly. So look at last April, we outperformed by about 1% during the tariff fallout of last April. Outperformed by 1% there. And all those 1% make a difference because if you think about it, if you're down 50% in a hypothetical world, of course, if you're down 50%, it's not 50% you have to gain back to be back where you started. You need to grow 100%. You need to double your money again to get back. So by protecting the fallback, it means that we can not necessarily have to chase returns as hard in that market. Over a longer economic cycle, we can be more measured in our approach and generate our returns in a better risk manner. Top and bottom performance for the quarter was a bit of an interesting mix, actually. Not the usual story that we usually go down. So some actives worked very well and some didn't. So the Artemis Smart GARP Global Emerging Markets, for example, on looking at the P portfolios, ranked number 3. Returned 5.33% compared to the passive. You can see there on the R ranked number 5, 1.7%. So those active funds, delivering in some cases very, very healthy returns. However, Dragon Vietnam Enterprises ranked number 4 on the bottom, performing on the P portfolios down 4.66% versus the global the emerging markets passive up 1.7. So don't get me wrong, we hold a far smaller position in that Vietnam position than other parts, so it doesn't have as an outsized effect on the portfolio. But it's been a blend on the month in terms of active versus passive fund performance. I think dealt with the framework that it's in, did quite well. What didn't help towards the end of the quarter was the pullback of sterling versus the dollar. Within P, we have an element that is currency hedged. And so when that happens, it means that the hedged position underperforms the non-hedged position, which is a shame. But it means that at the moment it's recovering a bit faster. So that's part of what's going on there. So something to take in general. On the quarter, we were very happy with the portfolio with this quarter, and it only really ended up changing as a result of the Iran conflict. So there was one day where all the trades went through, but they were considerable in terms of quantity. So all in all, I think I counted it last night. It's something like 17 portfolio trades, and I'll talk about in a moment why they happened. But some key outliers was a pullback from the Man Group Sterling Corporate Bond Professional Fund, which I will mark here. Up to 7% in P1. It was a very large holding in P1, to be fair. We sold that and put it into one of two places. Either put into the passive equivalent there, or we put it into this position here, which is a fixed income to bonds long short position. So what does that mean? It means that it can generate positive return in negative environments. It's a position that we've held for a little while now. Just think that the increasing inflationary picture is going to create an environment where a few companies are going to struggle a little bit more on, say, interest that they have to pay on their debt coverage, and so this is a fund that can benefit from those environments. Not saying that in general the market is in a bad place, but we came from a position coming into this quarter where credit risk was very, very cheap indeed, which means that there's potential for this long short position to outperform for a little while there. As I said, the elephant in the room, can't go not talking about it. So this comes with the caveat of this was updated over the last 12 hours. It might have all changed since then, and particularly when the recording of this webinar goes out, obviously everything seems to be changing so quickly, and it means that our scenario planning that we've been doing, which is generated like 2-3 times a day, being updated that regularly and comprehensively as well at that, is it's a very ongoing process. So, and that's one of the key things I was saying at the moment, is that if we were to have traded every piece of news lately, we probably would have ended up swapping around the portfolio a huge amount, at least 5 times over the last 4 weeks. And it wouldn't have been good for the portfolios to do that, because every time we do a trade, there's a day or so where the portfolios are out of the market. And what's been going on is that, yes, the general trend over March was negative, but you had some very up days as well as some very down days, and they were quite often next door to each other. So you could have ended up with a situation where you've ended up selling things low and buying them back high. So you have to be very careful when you traded over the last month. So this week, you would have seen the news yesterday about a 2-week ceasefire being brokered by Pakistan, and which on the face of it is a very positive thing. This was conditional with Iran reopening the Strait of Hormuz for safe passage, and it opened the door for talks beginning on this Friday to negotiate a permanent deal. So we'll see how that plays out. Unlike the rest of the market, we read this a little bit differently. So whilst on the face of this, you read it and you think, great, ceasefire, it's true. There's two very different claims of victory here. So I think the key part in this is that Iran was saying that the US accepted its 10-point plan, and Donald Trump, in one of his many tweets, etc., or Truth Social, whatever platform is on this week, said that this is a great point to negotiate from, as in talking about this 10-point plan. The thing is, though, the 10-point plan includes permanent Iranian control over the strait, and that means quite a lot. So what that means is that Iran will be able to, you might have read about, impose tolls over transiting the strait, which is an interesting legal position that we were discussing internally today, which is about $2 million per oil ship transiting the strait, which is obviously an inflationary factor. And not just that, it's a little bit of a cost that, how can I put this, that is going to obviously revenue for the Iranian state, and what they do with that in terms of where they're going to prioritize their spending, question mark. So that's something that's possibly not very good. Also, there's a huge amount of shipping that still this morning is still at anchor within the Strait of Hormuz. So I think north of the Strait of Hormuz, waiting to transit through, because they're waiting for guarantees that they're not going to be attacked if they try to do so, which is really quite interesting. But the thing was, though, is also when you looked at the statements from both sides, they basically said, yes, we would abide to the ceasefire so long as the other people stop hitting us. Well, you can't both wait for the other person to stop hitting you. One of you has to do it first. So looking at yesterday, so Iran, this hasn't been covered in the news much, actually. Iran struck Saudi's east-west oil pipeline, which was the way that they were managing to get some of their crude oil still out of the country. So this was kind of more like Red Sea kind of area. And that being hit, it's a question mark now about how much can the Saudis now get out at all. So that's not good there. The Iranians also struck all facilities linked to Saudis in that Red Sea port as well. So again, not great. Kuwait intercepted another 28 drones, so the UAE intercepted more drones and missiles. But Israel, bear in mind in this, Iran considers Israel to be a US proxy. Israel launched its most intense day of strikes in Lebanon, which Iran said very clearly is like, literally, you do this at all much longer, we will say this ceasefire is null and void. And so that puts the ceasefire in itself very much at risk. And so how much is this ceasefire going to make a difference? Uncertain, particularly when, as it says on the bottom there, look at it yesterday, only 2 ships went through the strait yesterday. Neither was carrying anything. As I said, Maersk said that it doesn't have enough security to resume operations. Those 2 ships transiting is actually lower than at any point last week. So things haven't improved yet. And when you bear in mind that the last crude oil cargoes are now arriving, like this week, into European ports, you're now going to find that the oil refineries might be struggling now to get new flows of oil. And this might be an issue, particularly in France, is one place that we see might have issues. But it isn't just about oil, and I think this is an area that people are missing. So yeah, oil, 20% of the world's daily supply, and even though, say, UK doesn't take that much oil from from the Gulf region. It's the fact that you then have to compete with everyone else who's trying to replace those supplies. So that's going to be, as we already know, a knock-on effect to us. I think a big problem for Europe is the global LNG. So that's liquid natural gas. We had for the first time since the Ukraine conflict started, a colder winter, not the coldest ever, but certainly a colder winter. We've had very warm winters since, which means that our gas storage is at a very low level that needs to be replenished up. So you've got to go replenish more gas than you would normally have to, and it's going to cost a heck of a lot of money. We also see that when European gas goes the wholesale price above 70 euros, we start to see then at that point that industrial processes start stopping because it's just too expensive to run, which means obviously you have the economic hit and so on and so forth. So that's one thing we're very aware of, and that's why we actually sold European government debt. We cut it in half a couple of weeks ago, just because of the inflationary factors will not be good for Europe no matter what the outcome. 46% of global urea comes out from the Gulf, and urea is a really important component when it comes to fertilizer. And Northern Hemisphere needs that fertilizer literally now for this year's harvest. So food prices, we've had a couple of calls, and basically we are looking, even if the Strait transiting was to start today or hunky-dory, another 7 to 8% above normal food inflation feed through. And if this goes on for not much more, the difference in crop yields will result in food inflation again of this type of the Ukraine conflict, which, as we know, was not insignificant. And obviously that'll have a huge impact with, as politicians will have to call it now, the cost of living crisis, which seems to be never ending. The Gulf is, again, it's not necessarily just, just oil. 20% of global raw aluminium comes out from the Gulf. And not just that, a lot of the smelters within the Gulf area are south of the Strait of Hormuz, and therefore rely on gas flows that come from the other side. So that's going to be a knock-on effect there. Helium is a really important component with basically when you need environments. It's 1/3 of the global helium production transits through Strait of Hormuz, and you need that for semiconductor manufacturing, medical equipment. So there's going to be a big knock-on effect there. What will happen with obviously the AI kind of build out because of that would be really interesting. And as you can see, it goes on there. Obviously, the thought that you would think of is obviously these elevated prices creates opportunities to buy in other places. It's difficult to work out what point in the chain. So, for example, higher food prices, we were looking at buying agricultural funds. The problem is, though, is whereabouts is going to be the beneficiary from this. It's not going to be the farmers, because they're going to have to pay a lot more for the fertilizer and or their crop yields are going to be down, so that's not beneficial for them. It's not going to be the next stage down, because basically who's going to be wanting to buy equipment to replace what you already have when your crop yields are down. You're not going to buy more equipment when you haven't got as much to go through. You're not necessarily going to be going after other elements of fertilizer either to complement or rekindle, etc., because you just the costs. It's going to cost more to produce it. So even though you're selling it for more, your margin hasn't benefited. The only people that benefit is literally the commodity space, which is actually why this week we will be buying a global natural resources fund, possibly moved out from the global gold fund, just because obviously that becomes part of it, so to speak. Just because of this is an area where we think now that we've had this ceasefire, people have got a bit too optimistic. And it's now an entry point. It would have been to do so around about 3 weeks ago, because that was when, so to speak, you were in the mania. So therefore, you ran the risk of, if there's a big pullback, as we saw yesterday, it leaves you rather exposed. So timing of these trades is really important. And why energy prices will not return to pre-war levels quickly. I'd like to point out, I'm trying not to be entirely negative in this. There are some areas which will certainly do better in the world. So, as I said, 25 large tankers remain an anchor, and we've had another strike on the pipeline, which is actually taken even more supply out from the market. And everyone's saying that even if it's open today, it will take months for the energy supply to return to normal, because obviously you've got to take into account the transit of ships around the world. They will be already on plan to do transits from other ports, because why would you go to Strait of Hormuz at the moment when it's closed to stand around for months waiting for an oil shipment? You wouldn't. There was permanent structural costs, as I said. The ceasefire terms includes a permanent on ships. And there's gas and oil facilities that have been struck, which will take time to rebuild. So 20% of Qatar's gas facilities, excuse me, which again was 20% of the world, so circa 4%, which is, in this kind of a commodity, 4% shift on supply is a big amount. It will take months, when we talk months, we mean up close to a year to several years to repair. Excuse me. So that's not coming on for some time. The global shipping costs are going to be elevated for a long time. So the cost to insurers to go through Strait of Hormuz, sorry to anyone wearing headphones and I'm coughing in their ears, was about 0.1% of the total value to go through. It is now, as of yesterday, so things have come down, 3.5%. So that's another 3.5% of inflation to add on to global shipping, potentially there. And not just that, it takes a while for those contracts to come into place. So I think someone said around about 3 weeks before insured shipping will start going through at a normal level at all. The other problem is that we've had, obviously, you would have read about a global drawdown from strategic reserves to help kind of settle global markets. They need refilling. They were at a very low level even before this. The cost, obviously, to refill those will put a floor on commodity prices, on oil prices particularly, for several years to come, which is obviously not good. Obviously, from a UK standpoint, the energy price cap is going to be set in July based on what's happened over this quarter. So that could be interesting to see how it plays out, and whether there's going to be any state support in the winter months, as we saw a few years ago. That's not going to be good for gilts, because we're going to end up with high inflation and added cost onto the government, which is what gilts obviously are financing. So that's why we've moved a little bit from a more longer dated UK government debt, which is more sensitive on interest rate changes to the value of it, and moved that to a lot shorter dated debt. It tends to be not as sensitive to interest rate changes. I've kind of spoken already about the changes we've been doing. As I said, reduce longer dated bond exposure, which loses value when inflation rises. Upgraded the credit quality. That's what I mentioned there about selling down some of that Man Sterling corporate credit and moving it into that long short fund there. The European government debt, as I said, they're very exposed on inflation, and they're going to probably have quite a bit more state support to roll out. Notice that they were basically at the end of their rate cutting cycle anyway, so the odds were stacked on things going in that direction anyway. Have moved that into very short dated inflation protected securities. So as inflation rises, the yield that they pay out becomes more. And just a slight defensive element, shifted US equities. So we had a portion in US smaller companies, which tend to be very sensitive on inflation rate changes. Moved that into the S&P 500 tracking, just because of it tends to be more resilient in these kind of environments. And these core trades have delivered positive value since their execution, which is good. It shows that we're doing our jobs there. This week, two further actions, one of which was done yesterday, which is rebalancing VR portfolios, which I'll explain in a second. And also, as I said, we're going to patch that wider natural resources fund, just because we feel the pullback in commodity prices recently has been overdone a little bit. We need to look at more through 2026 and beyond view. As I said, we need to look at things as not a 1 week, 2 week viewpoint. We need to look at this as a bit longer. Why rebalancing are? So I'd like to point out those trades that went through on the P portfolios I mentioned earlier, they went through also as a rebalance. So when you rebalance, you're bringing everything back. So when we punch in our numbers on our systems, we punch things in as target weighting. Obviously, once you start your portfolio, some things grow more than others. And so therefore, the percentage of your portfolio that is held to a certain asset will drift away from that target amount. What rebalancing does is that it sells those that have overperformed from their target percentage, brings it back down to target, and reallocates that cash into the underperforming ones. So what that ends up doing, if you time it right and you time it when things have pulled back a fair amount, ready for a recovery, is that in essence you bought more, you sold the things that have been more defensive, that are likely to grow less quickly in a return environment, and you end up buying more of what has sold down quite a lot recently but should recover more. So you should recover quicker out of the negative downturn. So that's what we've done, and that should be very positive for portfolios in a couple of days ahead. And it's just part of what a managed system delivers. So what are we looking out for over the next few days? So, as said, there's the talks starting this week to negotiate permanent terms. A successful outcome would be a major step forward. We have our framework in place for the trades that we put into effect. Obviously, those update practically daily. As the situation changes, and we recognize different opportunities that are better than others. And not just that, there's a whole other world going on right now. So it's important that we keep concentrating on what else is going on in the world for our ideas. What are we actually looking out for? So we're not looking for rhetoric or just blank statements. We're looking for the things that actually matter. So oil tankers and cargo generally actually moving through the strait. Rather than just announcements. Announcements don't heat my house at night. They don't power my electricity. So we actually want to see those cargoes transiting through, and that insurance cost coming down to a degree would be a significant milestone. But that would change our inflation outlook, which I think is an important one. I think the Lebanon dimension is a tricky one because it is something that one side is more sensitive on than the other. But one side, the side that's been belligerent isn't necessarily part of talks. So obviously Iran is more sensitive on this than the US. However, it is the Israelis that are hitting Lebanon. So it's how well can that be controlled within that framework, and how likely is it to cause a flashpoint for the whole framework to fall apart generally. And the thing that we're waiting to hear, although we haven't heard yet, is the status of that pipeline and how damaged it is, and whether that bypass disruption strategy has become permanent. So what we're going to do for you, so as I said, we've reacted decisively. When we say reacted early, we've had this, for those who've listened to our podcast, we were talking about this being on the radar in January. We've been scenario planning this whole situation ever since then. Our scenario planning gets updated like twice, 3 times daily about the outcome of this. our plans for this, we're working on 4 potential scenarios and our framework for those, anywhere between a goods recovery, a settlement which is not necessarily positive, such as a permanent imposition of these tolls, and also obviously there's the outcome of that could be a full-on and increased intensity of military strikes, and obviously something in between. There's a degree of yes, we have 4, but looking at the outcome, we might be blending these together. And the key thing is that we're not looking for the environment that we're hoping for, which is what I think the markets were at yesterday. The portfolio is looking for the environment that we're in, and that environment is that we are looking at an increased inflationary outlook, and so that is what the trades have been made to reflect. Even if the ceasefire comes into effect, there'll be a degree of being selective about where we deploy capital, and that's very important. Right, let's look at individual areas. The OECD said the UK is the most exposed developed economy to this. Hooray, I say sarcastically, unfortunately. Reasons for this is we are now a net energy importer, despite what everyone's saying about drilling the North Sea. That would always still remain the case. The resources that are left in the North Sea to capture them is rather expensive to get hold of. So it wouldn't necessarily be a positive thing for everyone's back pocket. We do have pre-existing sticky inflation, higher than other areas. Europe, US, etc. have recovered from those 2022 inflationary shocks a lot better than we have. And the other thing as well that's not beneficial for the UK is we have a housing market that's heavily sensitive on shorter interest rate changes. So in the US, typically they lock their mortgages in for 30 years. In Europe, it's like 10 years. How we do things with 2 to 5 years is an outlier, and that makes us more sensitive to our housing costs. And not just that, we tend to be more leveraged than other parts of the world. So therefore, it means that our housing stock prices change around more based on interest rates. But looking at statements, OECD has already cut the UK growth forecast to 0.5%, down from 1%, which is the biggest revision they've made. The BCC, again, cuts their forecast, but employment rising up to 5.5%, which isn't necessarily fantastic. The BOE was already expected to cut rates twice this year. That's changed it to a 1 rise, which I think might be slightly under what's needed. And coming into this, CPI is at 3%. That's now expected to be around about 4%, possibly even more at the end of this year. And obviously, figures, a lot of what we pay for in the UK, it has inflation-linked aspects. So our phone bills are a very key example. They're IPI linked on their contracts. So it takes a long time for inflation to wind out from our economy due to the fact that even 1 year on, you'll still be feeling the effects of like primary inflation from a year ago. Current Cornwall Insight forecast, which were actually pretty accurate when we last had the inflation bout, was looking at around about a 10% rise just in July on electricity, up to around £1,800 per year per typical household. 10% is obviously quite a bit. It's not quite putting us back at 2022 levels, but we're not in winter yet, and that's the key thing. I think what will be really telling is what happens in the world around next Northern Hemisphere winter. Spoke to our mortgage consultant, that's the Ascot Wealth mortgage consultant, this week, and was saying that they were having offers pulled within like literally hours of them being offered out to clients. Just the mortgage market is being very, very fickle at the moment. And we're looking at 2-year fixes now up at 5.5%, which even on a £200,000 mortgage is another £1,000 a year. It's a large amount. And when you were looking at recently, not that long ago, we were looking at 2 to 5 year, I can't remember which was one of them, around about 3.5%. That's a big increase again. So that's a tricky one to navigate, unfortunately, and again is inflationary. Eurozone. I think Goldman's have underplayed the inflation problems that are possible to play out in the EU. They're projecting another around about 0.5%. We have that closer to 0.8%. But EU started from a lower inflationary standpoint, started from 2.5%. So they can weather this better in that degree. It's where, as we all know, energy costs are something that disproportionately affect the less well-off in society. And therefore, governments feel more obliged to support those costs. And then what would that do to their sovereign debt? So that's why we cut that. Germany, obviously being quite a manufacturing economy still, is exposed to high gas prices. Already that forecast been cut to 0.6%. And as I mentioned there about European gas storage, etc. And ECB said about prolonged conflict would trigger stagflation. And that's why you avoid bonds in the Eurozone. That's literally that one statement there. That's the worst outcome for bonds. So that's why we've been positioning these more for the US, and for areas of businesses that can weather a higher inflationary outcome better. We navigated this very well in 2022, and it's an area that we've done quite well with in the years since. So we're highly confident that on fixed income, which is somewhere, as I said, inflation tends to be very negative on, we can navigate this quite well indeed. US, there's something when you read about US inflation, and they're saying about we've now gone over $4 a gallon on petrol, and which obviously still works out to be less than $1 a litre, which works out to be around about 70 pence a litre. It's a little bit surprising. Well, the problem is it starts from such a low baseline in America that obviously it has quite an effect with them. Again, as expected, a pullback in growth speeds, increased inflation there. Interesting, Goldman's are saying US probability of recession raised up to 30%, Moody's 49%. I don't see a recession in the US. An awful lot of their economy is services orientated, and not just that, they'll be benefiting from some of these issues in the sense of like they are a net energy exporter. It's whether things like the other aspects, such as on fertilizer, etc., how much those are going to hurt their economy. And that's mentioned down here. As previously did, the US Strategic Petroleum Reserve was already at its lowest since 1983, before the war. So refilling this is going to take years and add a floor on it. We're not going back to circa $70 oil for 5 years, at least, which is a shame. But equally, with how it works in the UK, with the fact that renewables, the price that we pay for electricity generated by renewables is linked to natural gas price, it's not necessarily a good thing from buy an electric car instead, unless you're very fortunate to have one of those great overnight tariffs. Worry about running out a little bit of time here. Emerging markets typically are the most exposed, so that's why we've got Holden Active here. They'll be able to navigate this a bit better than the passive. A passive, you don't really get to choose where you are exposed to. You're spread across the countries no matter what the risk, whereas with an active, you can pick and choose based on the risks from this fallout where you want to choose to be invested. India, bear in mind, India has a very large agricultural element to their economy. It imports 66% of its urea and 50% of its LNG from the Gulf, so it's really, really sensitive on that one. which is why even though we really like India, we've pulled back from buying it. Some Indian fertilizer plants already cover output already, so that's not good there. The Philippines have declared a state of emergency in regards to fuel. Zimbabwe, Pakistan, Bangladesh, Nigeria, and Vietnam face severe fuel shortages. I remember seeing even 3 weeks ago, South Korea have implemented a rota system with when you can drive. I think it was 1 day out of 5 you couldn't drive, might be less than that, but they'd already implemented that. Emerging markets stand to be hurt more by commodity shortages than Europe or the Americas. As I said, it's really important, I think, that we're active in that space, which is where the P portfolios might benefit more than the R's. As I said, just that last section there is talking about food inflation issues, which I think could be rather telling over the years ahead, months ahead. But as going back to way back to here, year to date, we're up despite everything that's going on. I think the message that we say that we're doing is that we are being prudent in our approach. We are one thing that we haven't done awfully on scale is pull back on equities. This isn't necessarily an area where equities would underperform bonds. If you think in an inflationary environment, companies charge more, which ultimately protects their margins, which means that in nominal terms they perform well. But we've been looking for ways to protect portfolios better and look for areas that would grow better in this environment. I think that's the key thing. I think if I leave it on that. Isa, did you want to take things back off me?
Can you hear me? Is the sound working? Okay. So I'll just move it over to the survey. Anyone would like, they can fill in this short survey, and then if you have any other questions, please pop them into the chat, and we will get on as soon as possible. Thank you to everyone who joined the webinar today. The recording and slides will be shared in the following day or two, so stay tuned for that. And without any further ado, have a brilliant day further. Cheers, guys.